Hello and welcome to the Ask Assaad Show. I'm Michael Gaines and glad you're joining us today as we continue our conversation and bring insight out, bringing you expert analysis and perspective on the energy market and all that it entails. And we are always glad that you are a part of that conversation. So thanks for joining us today. Before we dive into today's conversation, we're going to head over and bring in Shelby Domain to talk about how you can be a part of our conversation today as well. Hey, Shelby.
Hey, Michael. Absolutely. So, I wanted to mention here at the top that typically we ask everybody to send in their questions. And while we still, love that, we definitely want you to ask Assaad as the show name goes. We also really want to encourage everybody watching this episode to let us know any comments you have as well as questions. So if you want to join the conversation and everything we're talking about today, if you have thoughts on anything Assaad is talking about or Michael, please let us know. And we'd really like to maybe highlight some of those or just kind of read what everyone's thinking in the comments as well. So speaking of, where do you put all of your great insights and questions? You can do that in the comment section. So whether you're on Facebook, LinkedIn, or YouTube, go ahead and comment below. And like I said, I'm in the comments throughout the entire show. We're reading those and really look forward to hearing your thoughts on today's topic. And then after that, if after the show you have any other thoughts you'd like to send to us, maybe ideas for a future topic, if you'd like to hear something, there's a couple ways you can reach us. The first is by email, and that's askassaad@nov.com. So you can shoot us a quick message there. And then if you would rather kind of talk on the phone, then we can do that as well. So you can call us and leave us a voicemail. That is country code +1 346 223 4799. So again, whether you're commenting, emailing, or calling us, we would love to hear both your insights and your questions today for the Ask Assaad show. So I look forward to seeing everybody in the comments.
All right. Thanks, Shelby. And we'll go ahead and bring in the show's namesake, Assaad Mohanna, Director of Business Strategy here at NOV. And Assaad, I know that what folks don't have the privilege of seeing is some of the spirited debates that happen in these hallways here at NOV. So I know that you're always open to opinions, those that agree and maybe sometimes disagree.
I tell you what, Michael, the more I think of this show and how long we've been doing this, the more I think it's been great having an existing infrastructure of shows before COVID, because really, to your point, it's catapulted us into the social media space. So right. Yes, no shying back from sharing our own insights.
Sure. No, absolutely. So I know, so this 33rd episode of the Ask Assaad show is one that we're using as an opportunity to kind of really dive into several topics of conversation. I know normally we have a special guest, but I think our viewers are going to be our special guest today as we're sharing quite a bit of insight today.
That's right. We had some great guests in the last, I lost count, maybe 5 or 8 episodes now back to back. Didn't get a chance to have another one-on-one with our audience. So this is sort of an opportunity to catch up and go over a lot of things that happened really in the last few weeks. Starting with perhaps big merger announcements. We've had lots of earnings being reported in the last several weeks. And of course, a big election in the United States that affected the landscape of oil and gas.
All right. Okay. So kind of when we're looking at sort of all those items, I mean, would you say that, if we kind of had to force a theme or so for folks to kind of latch onto as we're talking, how do you maybe anchor that?
Yeah, I would say this is timely because what we had expected in the last several months is that this downturn would last quite a bit. I think the theme would be 2021 perhaps starting to appear like a better year than what we'd expect, or what the analyst world has expected previously. I think more granular to that in terms of oil price, I think the expectation was for the $50 or $60 per barrel to come back in 2022, maybe 2023 now. I think those projections are getting a bit closer. And as we're going to talk today, there are some indications and signals out there that perhaps allude to that sort of oil price towards the end of this year into next year. And why this is important, I mean, I think it's a game changer, that $50 mark. Remember in 2014, everybody reinvented themselves back then and restructure to adapt to this lower new environment, which back then was the 50 forever, right? Everybody was gearing for that sort of environment. Now everybody's closer, asking for a $40, maybe $50. And listening to some operators at a couple of events that happened recently, one of them SPE, ATCE conference, the other one was the IADC annual general meeting. If you heard some of the big industry players, you'd hear that 45 plus is probably where everybody's okay. Everybody, the industry could do well. So yes, a theme would be for this conversation. Things are starting to look good.
Yeah. All right. Well, then maybe using that as a launching off point, let's kind of talk about some of the things that have happened and certainly have helped shape the markets and maybe use that as the lens that we look through as we look towards 2021. I know you've got a laundry list of items that have really had major impacts, but maybe we can kind of dive into some of those and then use that as a pivot point.
Yeah, we never got the chance to speak on this show about the mergers that happened. Mm-hmm. We did have one show about Chevron and Noble, but I think 2 or 3 others happened since that deserve to stop a little bit. One was Devon WPX. The other one was ConocoPhillips and Concho. And the last one was Pioneer Energy Resources and Parsley joining forces together. Why those are important is because it's a continuation of the consolidation of the industry towards a more restricted sort of demand for services, a more restricted capital disciplined production way of development. We've seen how some companies have struggled, and instead of going the bankruptcy route, they've merged forces through an all-stock deal, like most of those that I mentioned, let alone other mergers that have happened in the last several months that are a bit smaller in size. What's important about this, and I think the Spears brothers did a good job in their last episode discussing sort of the service supply aspect of things. When Pioneer and Parsley get together, that means the buyer would decide what the new supply chain looks like. And when you have overlapping regions of operation, that means there are winners and there are losers. So in that case, when 2 companies merge, yes, you end up with a better company. Yes, you end up with better acreage because eventually that company is going to let go some of its assets that are not as well performing. But also it's going to require less suppliers, less services, because it's going to consolidate. It's got its preferred suppliers. So on the one end, that lower demand of service is going to trigger lower supply because you don't need as many directional companies and cementing companies. So that consolidation at the operator level is going to trickle down and result in the OFS world consolidation as well. It's going to result in companies in OFS also triggering their own internal consolidation. And what I mean by that is asset write-offs, it's reduction in fleet sizes. It's not just parking frac fleets, but literally getting rid of frac fleets amongst other equipment. So really that trickling down, that signal of a merger trickles down and really gets us to a place that's a bit better in terms of the supply and demand for services. Now, you take that on the other end of the spectrum in terms of production. Again, these merged operators are going to get out of leases and assets that are not as well performing. So we also expect that same capital discipline on the downstream to apply on the upstream of that operator.
Right. Right. So I mean, and so I know. So we talked earlier, and in looking at 2021 and looking ahead, recognizing some of the market indicators that we've seen historically that to a certain degree in some aspects we're experiencing now. I think it was your opinion and perspective that the overall market dynamic is one that supports ultimately a higher oil price next year. And I think you boiled those down to about 5 main kind of areas that you said when you kind of put all those pieces together, at least in the very hazy crystal ball that we have, which is quite hazy, gives you at least a feeling that, hey, if these things kind of all fit together right, could indicate a better 2021, especially when you look at oil price. What can we let's maybe dive into those, and maybe you can kind of lead off. You've already kind of talked to one already.
Yeah, absolutely. So the first one is clearly that market consolidation that we talked about. And maybe a quick reminder on that. When we talk about oil prices, we're talking about low oil prices with respect to recent history. If we go back in time, the average between in oil prices between 1986 and 2003 was $33. So when we say today 45 is a low price, that's really very relative to what we've seen in the 2010s. So that market consolidation, goes back into really forming a different structure that's adapt with this new environment of oil price. So the second attribute or factor that I think has supported this more positive projection for 2021 is the earnings that we've heard from oilfield service companies as well as from E&Ps. The overall environment, Michael, was that everybody's restricting capital spending so that people are retaining cash. Companies are paying down debt. Whoever is filing for bankruptcy is really coming out of bankruptcy even a better company, because remember, Chapter 11 means the debtor becomes an equity holder, meaning the debt to service on a monthly or yearly basis has shrunk. So the company doesn't require as much cash flow as it did before the bankruptcy, which means they can operate in a more lean fashion. So the overall kind of overarching topic for earnings has been one of capital discipline, paying down debt, making sure that that consolidation cycle keeps going, find a good match, good fit in the industry where they can operate. And when we heard from the E&Ps, that capital constraint was also echoed really well. But what was interesting to see was a projection for lower production overall from shale, down from the 9.7, maybe 10 million barrels that came just from shale in February, down to close to 7.7 towards the end of the year. That's a significant drop. And when that happens, Michael, going back to the 10s not as easy as or as quick as going back down that route, because it's all that reinvestment to be made. It's the infrastructure to rebuild, and it's not easy to go back there quickly.
Okay. So we talked about the consolidation, of course, the service companies, as well as E&P companies on the earnings side, certainly is something that piques our interest as well, in addition to some other items that kind of complement that as well. But the earnings season, like we've talked about before in previous episodes, has been one that certainly gave rise to some optimism looking
right
ahead.
Yeah, for sure. And we even heard some companies not just reinvent, but acquire some more energy transition companies. We've heard Baker Hughes do that. We've seen companies really look at digital in a very different way as a transformation means. It's really, I mean, it's that message of we got to do things differently, and I think that's the bright side here with earnings is that everybody realizes it's no longer just a matter of shrinking capacity. It's not a matter of cleaning up balance sheets and writing off assets that we don't need anymore, but it's also a different way of thinking, which I'll talk even a little bit more about. But the third point I wanted to bring up here was the DUCs, or the drilled uncompleted wells. And one trend that we've seen, and we kind of predicted early on, was that you had several thousand wells out there that have been drilled but not completed. And the addition to that pile of DUCs was in the hundreds a month. Now, clearly that number, or that growth rate, shrunk significantly or disappeared. But what we're seeing today is, instead of going and drilling new wells, operators are electing to go and frack those wells, because usually that's the most expensive part of the well. So now that the drilling part's complete, frack them, get some production out of them, and then gets that a bit of cash flow to really go back into drilling at a later point. So that trend's accelerating quite a bit. We've seen frack spread crews increase by 50% in the last 2 months, which is a pretty significant jump, a lot faster than the increase in rig count, which was only about 10 or 15%. So quite shy. And I think we'll see a low rig count environment for the next year. No big change there, but the fact that E&Ps are aggressively going after their DUCs is a pretty encouraging signal.
Right. Okay. So here's one for you, Assaad. I wish I could say I memorized all these. I've got the notes that you sent over, and one of the items I saw in here, you said that the automotive industry earnings was something that popped up on your radar, honestly, that had kind of been off out of my perspective for a while, mainly because I've been thinking that folks have been, drop anchor, at home and really primarily working from home and not doing a lot of movement. But some of the latest numbers, both from a unit sale and financial reporting, indicate actually the exact opposite, that folks are consuming more vehicles and more in that space. I thought that was quite interesting.
It's amazing, isn't it? When we were looking at the performance of the automotive industry, we saw something that wasn't expected. The people are going back to buying cars. What happened in Q3 with automotive? We looked at General Motors. We looked at Chrysler, Fiat, companies like Ford and others, and the jump quarter over quarter was 31% growth. And I think when you put things in perspective and read through their earnings, it seems like people are going after SUVs, but also energy efficient vehicles, which in both cases means that people are going back into driving. Some of them are encouraged to go back on the roads and back to working from offices, and which is encouraging, clearly, because more, if you buy a car, you better be driving it. If you're driving it, that's good for the economy, and demand for fuel increases. Is that do we have a precedent to compare that to, where more sales of vehicles resulted in more activity in oil and gas? I don't have anything to compare this with, but I think it doesn't take too many brains to say there's perhaps something there. Economy is seeing some signs of relief. People are spending some money again, and looking into getting back on the road. So to me, that's one to keep an eye on. How far is the lag between buying a car and resulting in a need for an additional barrel. Is that weeks or 6 months? I don't know.
Sounds like homework for Assaad Mohanna to me.
Yeah, thank you.
Yeah, no, absolutely. So, all right. So, we've talked about, consolidation in the market, service companies and E&Ps. We hit on the drill but uncompleted wells, and certainly talked about the automotive space. Kind of rounding out your top five there is, as always, I'm super predictable. So talking about business models or new business models, really, in that regard. And I know that's something that isn't a stranger to our conversations here as well.
That was a refreshing one, Michael, because we've been talking about it all the time, but the supporting data has been anecdotal more than widespread across the industry. But listening to Clay Williams, NOV CEO, in his address at the IADC annual general meeting last week, where he typically, on a yearly basis, presents the NOV census, but also a drilling survey that takes a subject every year or a theme that our colleague Steve Thompson carries. We saw a response from the industry, and remember, this is a drilling survey that goes widely into our upstream oil and gas. It goes to hundreds, if not thousands of people, and asks a bunch of questions about what are you doing in this environment. And there was an overwhelming group of respondents that said one way to get out of this is better business models. What was also interesting there was that when the survey asked and respondents responded with what kind of business model does that look like, the overwhelming majority said it's not turnkey. So we know it's a different way of doing. It's not the day rate, but it's not a turnkey. It's somewhere in between. It's certainly collaborative, but certainly a change of how we do things today. And I think Clay Williams said it really well. When you go out there and oil prices are back up, don't treat it like it's business as usual. Don't go back to 2019 or 2014 and say, we're out of it. Let's crank up the production, the activity. Let's buy assets. No, we got to do things differently. And I think it's great to hear that you and me are not the only ones talking about different business models anymore in the oil industry.
Right. Yeah. No. And that will be really interesting to see. And in a perfect world, it would be great to know that with these, kind of five things that we've talked about, that everything will just be smooth sailing. But as I prefaced earlier, in our very, very opaque, almost brick-like crystal ball, we don't have the ability to see that clearly into the future. And so there are some items that we've got to take into account, especially as we look ahead, and certainly keep in the forefront of our minds as well.
Lots of uncertainties about the oil price for sure. We cannot just like nobody could predict what happened with COVID. Nobody can predict what's going to happen in 21. But we kind of have a handle on these uncertainties. We know what they are, so we can kind of factor them in or understand what they are and try to at least keep an eye on them. The first uncertainty clearly is what happens with COVID. We heard some news about a vaccine being ready towards the end of the year. Whether that translates into a better economy fast enough, we don't know. So I'm really not going to spend much time talking about that just because it's a big, massive unknown. The other one is OPEC Plus and what they end up doing with supply or production. There have been talks about OPEC Plus extending the production cuts or even furthering the cuts into less production. So more unknowns there. We'll see what they end up doing. I don't know what will happen there. If I were betting some money on this, I would probably say we will see OPEC Plus extend, but you never know. The third thing with uncertainties is Libya. Yes, Libya. And that's surprised because Libya has been under the radar entirely because of the military conflicts that have been occurring there. But recently, I mean, in the last 6 weeks, Libya has come out with a truce between the militant facts there, and shifted from producing just 100,000 barrels a day to 1 million barrels a day today. I mean, in 6 weeks, that's a massive achievement. I mean, kudos, but also that's a big uncertainty and unknown. They plan on taking that to 1.3 million by 2021. They are part of OPEC organization. They are the largest reserve in Africa. So it could be a significant player in that whole game. How they factor in with OPEC plus cuts, we have yet to see that. The fourth uncertainty, we don't talk about offshore, but offshore has also paid the price during this downturn. Less capex from E&Ps means offshore has also taken some delays and shelving of projects. What will happen with offshore is an uncertainty. We've seen ultra deep water drill ships day rates increase a little bit in the last 4 months, which was very encouraging. Although jackup day rates have dropped overall around the world on average. But again, what happens offshore? Do we see that same shift we saw 15 years ago, where operators offshore shifted to shale and made that significant moves? Are we going to see that other way of shifting in the other direction today? Some companies may decide that they want to bet on something that's more reliable, maybe. And then my last one, Michael, and that's my fifth uncertainty, is the one that comes with the elections. And as we've heard about the frack ban on federal lands, I wanted to kind of address that point because there have been some concerns about it. Bloomberg recently put a good article on that, kind of describing what that meant. But really, to me, it's a non-issue. In short, frack ban in federal land will likely not affect our industry much, just because not too much is going on in federal land in terms of fracking. Some areas will get affected. We know about Piceance in Colorado. We know about some areas in Wyoming, and the Permian Basin will be affected in the New Mexico region of the Permian and the Delaware Basin. But generally, I mean, certainly as a whole, there's not going to be a major impact. Certainly for Texas, very little, if at all, impact, just because Texas does not have federal land.
Mm-hmm. So, as we've taken a dive into both the areas of focus or optimism, as well as areas of maybe continued, maybe having a watchful eye on, we can say. How do you sort of wrap all this up as we transition now? We're let's see, so we're almost mid-November now, heading into December, and then about to jump into hopefully a fresh, squeaky clean new year. Yeah. How do you sort of sum all of this up for us?
I think the worst is behind us. I think we're at 45 today for Brent, $42 for WTI. But really, I mean, that came from a bit of up and down the last couple of weeks. But really, if we're going to project for next year, I think we'll stabilize in the 45 plus, $50, maybe close to 2021 with closer to $60, which to me is a major signal of things going back to certain normal. A lot of uncertainty goes around that, how things go with healthcare crisis around the world, recovery of the economy, but things are signaling that the world is adapting to this new reality, and supply and demand are kind of balancing out kind of reaching a happy medium.
Mm.
The mergers that we talked about are certainly encouraging to see that consolidation of the industry into better organizations, better producing assets, less capital intensive, and certainly, a discipline of restraint when it comes to spending where in places where you simply just don't need that supply. So that capital restraint is very, very important. I think we'll see a lower rig count, lower frac spread count, or really optimized. I mean, we say lower. I mean, it's all relative. Optimized in the next year or two. The shale industry is adapting. I think offshore we'll see some relief, some activity going back, just because it's a safer bet, not as fluctuating. Analysts have predicted or projected that in terms of worldwide demand, we're going to see an additional 6 million barrels per day increase in 2021 compared to the 20 million drop that we saw this year. And at the same time, we're going to see shale kind of contract a little bit. So really, overall, demand growing faster than supply, eating out from that oil reserve that we've piled up over the last many months, and overall, really resulting in a higher oil price. Really, all hinging on capital discipline, operators going and saying, yeah, it is a better oil price. I'm not going to flood the market with oil, but I'm going to help maintain that environment in a healthy place.
Mm. Well, it sounds like we have Assaad's prediction for 2021, and I've got it written down right here. So I'm going to frame this and put it up. But hopefully, I think I have all of the more optimistic items on the top of the page. So hopefully, we just stick with those and can minimize all of the downsides. But really good insight and really a good set of items to keep our eyes on as we roll into 2021. So I know those have been your thoughts and perspectives. Certainly appreciate those. I know for those that are watching, again, we want to know what you think. If you agree on any of these items, or maybe you've got some insider analysis or perspective that could maybe sway Assaad's perspective. That I think that would be a good thing. We'd love for you to put in the comments or send us an email, and happy to talk to those. So I think that's been great, Assaad, and going to be looking forward to some additional conversation as we move into the new year. And certainly, as always, here on the Ask Assaad show, we value your input, comments, and feedback. So certainly send an email to askassad@nov.com. Again, whether you agree, disagree, or have a different perspective on any of today's conversation points, and we'll be more than happy to talk to those. So on behalf of everyone here at NOV and on behalf of Assaad Mohanna, I'm Michael Gaines. Thanks for watching and for listening, and we'll talk to you again next time.